Hey guys, it's MHFin. In today's video, we're examining two important measurements critical in helping traders describe liquidity and activity in option markets. These two terms, open interest and volume, are almost always displayed in any options detail page. On Robinhood, they are the first two items in the breakdown section, but these two measurements can be surprisingly confusing. Most newbie traders don't understand open interest and volume, and in this video, I'll look to clear things up by giving you a detailed breakdown behind the two numbers. By understanding them, you will add to your tool set, which in turn will help you achieve profitability and risk reduction. We start with the simple understanding that volume and open interest both describe the liquidity and activity level of contracts in option markets. Remember, almost every experienced trader will tell you to primarily focus on trading options that are highly liquid, so please make sure you understand this. There are all kinds of issues and drawbacks to trading options with very low activity, as the bid-ask spread and other factors can put you at a massive disadvantage. Unless you really know what you're doing, you shouldn't be trading options where liquidity is low. On top of this, understanding the volume and open interest measurements will help you make some basic inferences about the potential future movements of an underlying stock. Unlike stocks, which have a fixed number of shares outstanding with each company, there is no minimum or maximum number of option contracts that can exist for an underlying stock. The number of options is simply determined by trader demand. When you're trading options, you're doing one of four things: buying to open, buying to close, selling to open, and selling to close. This is why on Robinhood, when you go to make an options trade, it simply doesn't ask you to buy or sell. You have options. No pun intended. You have the ability to write and the ability to buy. Another way of thinking about this is to understand that the options market is not like a game of hot potato. Options are not passed around between people, always winding up in someone's hand. This is unlike stocks. When I go to sell my Tesla stock, someone else buys it. The total number of Tesla stocks in the market never changes. It's a fixed number called shares outstanding. Like mentioned earlier, options do not work like this. The number of options could be unlimited so long as there is enough demand. Someone needs to look at the bigger picture and get a count of outstanding option contracts within the market, and this is where OCC, or Options Clearing Corporation, comes in. Just like you learned in school, for every buyer there must be a seller, since you cannot buy something that isn't for sale. This concept defines a contract. A contract is considered open until a counterparty closes it. Adding up these open contracts defines the open interest, or simply the number of contracts that have not been settled. So in our world, this is a count of contracts that have not been closed out, expired, or exercised. Volume, on the other hand, indicates the number of contracts that have been bought or sold. Let's say Jake sells 2 puts to Brad, or the other way around to look at it, Brad buys 2 puts from Jake. This action would add 2 ticks to the volume figure for that particular option. Volume can never go down, it can only go up. This may sound wrong, but think about it. Options are time-limited assets, meaning they expire at a certain date and cease to exist. Volume indicates the number that have been bought or sold, and this number can only go up. You might be having trouble wrapping your head around the words, so let's jump into a couple examples so we can understand this. But before that, I just want to make a quick announcement. If you enjoy my videos and want to earn some free stock valued up to $200, please use my Robinhood affiliate code, which you can find in the description. If you plan on using Robinhood, please consider my link. Now back to the video. First, volume, as it's a little easier. Let's take a look at Tesla's option chain on Robinhood. Specifically, we're looking at the Tesla January 17, 2020 $270 call. It currently has an open interest of 1,040 and a volume figure that reads 78. This means that this specific option has been exchanged between buyers and sellers 78 times. For every buyer, there is a seller, and the transaction itself counted towards the daily volume. Investors see volume as an indicator of strength of the trade. The higher the volume, the more interest there is in the underlying security. Higher volume also means better liquidity, meaning it'll be easier for a trader to get out of a security faster if need be. Open interest, on the other hand, reads 1040. This means there is 1040 contracts held by investors and traders in so-called active positions. These positions have not been closed out, expired, or exercised. This number can decrease when the holders and writers, aka the buyers and sellers of these options, close out their positions. In order to close out their portions, they must take offsetting positions or exercise their options. Open interest can increase when investors and traders open new long positions or writers, aka sellers, take on new short positions. It can also increase when new options contracts are created. Remember, there is no limit to how many options contracts can be created. As long as there is demand, there could be more and more contracts. You can take a look what each movement for each of these specific numbers may mean for a stock by looking into a great article on Investopedia. I have linked it in the description below, so please make sure you check it out. Thank you guys for watching. If you enjoyed the video, please don't forget to hit the all-important subscribe button.